I would say that it was not without doubts along the way. I think that jump, I don't think I could probably lie or I could not lie and say somewhere along the way after the first few months, I was like, what am I doing here? I should be applying for jobs or something like that. Especially, you're offering, traveling, and nothing's hitting, but it's the reality. That's just the nature of the beast that, you're going to chase no matter what, and it's going to take time. And I think there was some gut checking going on there, but
This is episode number 16 of the Multifamily Success Stories podcast. Would you like to turn vacant units into cash and earn up to 3 times more per door without having to do any extra work yourself? We offer fully managed short-term rental solutions for multifamily investors. Go to managedbylux.com for more information.
Hey, this is John Bell
And Julian Sage.
and welcome to the Multifamily Success Stories podcast. This is a show where we talk to multifamily investors about their journeys and starting and growing their real estate empires.
Our goal is that you'll be able to walk away not only inspired, but with practical information to help you in your real estate journey.
Since we are a new show, please go over to iTunes and leave us a review and let us know what you enjoy.
And if you haven't done so already, go on over to our Facebook group, the Multifamily Success Network, to connect with the community. Hey, what is going on, Dealmakers? Julian Sage here. And in this episode, I had the special honor of speaking with Josh Eitingon, co-founder of DXE Properties, a real estate syndication firm that has $40 million of assets under management and 500 units. In this episode, Josh shares his journey from working on a beach, handing out chairs while learning to invest in real estate, to his first deal and raising private capital from friends and family, to now having over 500 units in his portfolio, raising multi-million dollars. If you'd like my show notes for this episode, go to multifsuccess.com/EP16, or if you'd like my show notes sent directly to your inbox every week, then go to multifsuccess.com/show notes. With all that being said, on to this week's conversation. Hey, welcome back, Dealmakers, to another episode of Multifamily Success Stories. In this episode, we have the special honor of speaking with Josh Eitingon. Josh, would you please introduce yourself to the Dealmaker community, let them know who you are and what inspired you to get into multifamily investing?
Sure. I'd love to. Good to be here. Thanks for having me, Julian and John. I started probably the way a lot of your viewers or listeners started at reading. I read like Rich Dad, Poor Dad, ABCs of Real Estate Investing, and multifamily apartments just made such quantifiable sense. One roof for 4 units rather than 4 roofs for 4 units. And in its simplest form, I was attracted to it. So I was reading, I remember I had a beach job, taking chairs out to people on the beach, just reading away real estate books. And I was hooked, even though I didn't go to college for it. I knew that was going to be a path of mine. So that's really what started me, nothing more than that.
Nice. Can you take us back to, so you said you're studying, you're learning about real estate. Can you talk to us about that first deal? You said you were working, taking out chairs on the beach, which sounds like a pretty nice job, but did you like save up enough capital and then just like purchase something on yourself? Did you say like, hey, I'm going to go straight into multifamily? Like, what was that transition?
Sure. My first deal, it was actually about 8 years ago. I was still living at home at my dad's. I was paying him $300 a month to rent my own room that I grew up in. But I did a lot of networking. The local networking group, sort of through a winding path, connected me to a property manager out in the Midwest. Younger guy, bit of a hustler, who was active, and I think I convinced him to like me. So he was my boots on the ground, and he helped me find my first deal in Cincinnati, which was actually a 20-unit property, a short sale, where I worked with the bank and the owner at the time to buy that property. It was 20% occupied, 20 units, $175,000 purchase price. And every step of the way was stressful. I think maybe I was young enough and dumb enough to just keep pushing forward and refuse to say no. And it was a big project for me, for my first project, really, without any experience or construction experience. I did not have a huge amount of money. I raised money basically in promissory notes to like my immediate family members, and tried to take as much risk as I personally could with the the little that I had saved. And fortunately, I think with a lot of luck and a little bit of skill, very little skill at that point, it ended up being a great success. We had to put close to $200,000 into it, but sold the property maybe a year and a half later for over $500,000. So it was just my taste into it. I certainly am not advocating multifamily flipping necessarily, but it got me into it, and I knew that from then on it was going to be real estate some way, somehow.
Wow. So, after that first deal, did you move out of your parents' house, or were you still there?
Yeah, sometime when I owned it, I did move out. I was working full-time for a software company after college. I was a project manager there. And I'd say the project management skills were helpful, but what I actually did after about 4 years with that software company, I almost cut my salary in half to go work for a real estate investment group, to take like an entry-level analyst position, where really I was underwriting deals. So I did that. I grew within that company to be an acquisitions guy for them, and ultimately for a short period of leading their acquisitions team. And it really just opened the door from a knowledge perspective and also from a relationship perspective that I was able to peel off and borrow a lot of those broker, owner, property manager relationships as me and my partner here started and built DXE.
That's definitely interesting, and I want to talk about that experience of working with that company. But going back to that first deal, what was your thought process going into that? I mean, you're taking money from, you said you're writing promissory notes to your friends and family, and you had a little bit of money saved up and you were willing to invest it. How did you go about that? Like, did you know like this deal is going to work or that it would make sense? That's got to be a lot of pressure, having that commitment to your friends and family to be able to pay them back.
Yeah, in hindsight, I'd never do it again. I think I think at the time I just was insistent that was the path that I wanted to take. I knowingly exposed myself a lot, although I had relatively little to lose at the time. But I think I put the people around me also at risk in a way that I don't think I would again today necessarily if I went back in time. So I think it was perhaps gut wrenching, but in the same breath, I don't think I even realized what could have gone wrong when I was doing that deal. I was just underwriting it. I had quotes from contractors, and I just felt like, okay, the numbers add up. What could possibly go wrong? So stepping into that first deal, I think if I went back in time, there was much more I could have done on just the education front, up front. I think underwriting in its simplest form is pretty, it's adding, subtracting. You're not doing too much. But really vetting and understanding each of the line items, the whole construction management, managing contractors was such a foreign process to me. I lost some there. The property could have probably sold for $600,000, and that would have been all my profit with the promissory notes had I not made some of the mistakes that I made along the way in that first deal.
What were some of because you said that, that was your first deal, maybe your first time really doing the underwriting yourself. What was that experience like from when you look back at how you were analyzing and, working on that deal versus when you ended up working with that company and you became an analyst and started doing the underwriting there?
I guess it's all data driven. So at the time, I was relying on the property manager out there who was telling me, "Hey, these line items are good. Don't worry." And you don't really know what property manager is aggressive, who's conservative, until you've just worked together. Whereas once I was working as an analyst with the investment group, we had deals that we were able to reference. We knew how salary operated. We knew reasonable turn costs. We knew reasonable R&M for different vintages. So it was much more defined at that point, and the variables were a little bit less. Although I don't think you ever remove some of the variables in underwriting.
With that first deal, did you make any? Were there any like major mistakes that you feel that could have been avoided if you had done something else, or if you had partnered with someone? Was there anything that you felt like, man, I should have maybe done something different?
I think the biggest difference is just when you're managing large, even then, I mean, it was a relatively large capital project for, given the size of the deal. We were doing a lot of work and had contractors out there. I was not out there often enough. Like now, these days, we're doing a big capital project, 104 units in Georgia. And even through pandemic, I mean, we've been traveling more than I care to share on the, just in terms of just, you have to be there. And I think that's in its simplest form, the most important part, keeping people accountable, responsive. I think that was something where I just let the leash go too far back then on that first deal. And I don't think I knew any better at the time, unfortunately.
Like did you just kind of jump and then figure it out as you were going? Or did you feel like, was there like something that you did or something that you studied or something that you followed that really kind of gave you like a good foundation for you to comfortably go out and do it yourself?
So I've always been a pretty good saver. I was looking locally. I'm in New York metro area. I was looking locally at different, I guess, 2-bedroom, or 2-family, 3-family, live in one, rent out the others, and I would do the math on that, and I mean, especially here, it's a pretty low cap rate environment, and I was doing the math, and I was thinking, well, there's no yield that I'm going to make on this whatsoever. So unless I have an outlook of like 30 years, there's not really. I mean, that's not true, but unless I have a super long-term outlook, what's a better path? What's possibly more scalable? And I think, I mean, now much more than then, there's so many resources online and podcasts like yours where you're just able to be exposed to different avenues. But I was a RIA near me that was pretty multifamily centric. There were a number of speakers that I just connected to, and just stayed in close touch with them, was able to learn, absorb, and then I was given that sort of connection to that relationship out in the Midwest.
And so that was the investor group that or that was the Cincinnati property that you found from.
Yes, that was the start, and then the analyst position was just sort of a mutual connection that I got connected with, and then was able to get that role and start and build from there. It's looking back, it seems much quicker than it really was. Yeah.
So why? I mean, you did a deal. You flipped the multifamily building. Like you made some profit. Why not do something a little bit bigger at that point? Like why go back to like an analyst position where you're kind of starting at the bottom over again? Like usually people would start at an analyst and then work their way up. For you, it seemed like you kind of jumped in, did it, and then you kind of worked your way back.
Well, I guess a couple of reasons. One, I knew there was a knowledge gap, which I think was clear. I also knew eventually there was going to be a path to entrepreneurialism and starting my own business. One thing which was nice when I did work for this company, they did allow some level of flexibility so that I could continue to do a deal or so a year, give or take. And I was able to do just that. They were not, the next deal I did the following year was a 44 unit deal. And then after that, a 62 unit deal. So I was able to continue to build there. Like I said, I did cut my salary almost in half. So they got a good discount as part of that. But to me, between what I was able to learn and the flexibility to keep doing deals was really helpful. I think, one reality of just syndicating deals is if you're offering relatively competitive structures just to investors, there's not that much money in some of these smaller deals unless you're hitting home run after home run. Um, I'm not retiring off of doing a $500,000 reno program that I hold for 3 years. I don't care how successful it is. And that was apparent to me, and it's still apparent today that, it's a business of that could, be really fruitful, but it's scale driven. You do have to build some scale to be really successful, I think.
With these with that real estate investment group, I mean, or like when you say you're really, to make a profit, you have to do it at scale. I mean, if you're doing it at scale, though, you've got other costs. Everybody's got their cut of the pie. And a lot of times when we hear from like multifamily investors, it's like, oh, I did, X amount of units, some, really large number. In the end, are they making more, or are they making less than maybe someone that's able to do something smaller on their own?
I don't think there's a right answer. I think it completely depends on what you and your goals are. I know that especially on the podcast circuit, there's probably 1 million people running around saying I've done 5,000 units and blah, blah, blah. Especially with how creative you can get with deal structure, it's to an extent, it's somewhat meaningless. But I don't know. What I do know is that a small team that is putting together larger and larger projects can really efficiently run those projects, asset manage them, and have a path to really do pretty well for both you and the investor, and be responsible with your time and run those projects accordingly. I mean, then in the same breath, you have funds that will raise hundreds of millions and billions of dollars and be staffed with 40 people to be able to do that efficiently. And I think those people would say you guys would be crazy to run lean and mean when you could be doing this. So I don't know. I don't know that there's a right answer. I know people on Long Island here that have 30 free and clear single family rentals. Can you beat that? I don't know.
What was that? You said you did another 44 and another 60 while you were with this investment group. What were those deals comparative to that first deal, doing it yourself without that experience?
Better. Both of them better. I think I continuing to learn. I was able to, my boss at that investment group became a bit of a mentor for me. So he really handheld me through a lot of it, which I think, was really meaningful. I think that third deal I did, that 62 unit deal, I actually just sold this year. Will probably be one of the better deals that I ever do. It was like a 400+% return on investment over 6 years. Some of that's a function of time, but I think you have to be in it to get lucky in a lot of cases.
Were those deals also in different states?
No, those first 3 deals were all in the Cincinnati metro, where I worked with the same property manager, and he was really helpful in just facilitating each of those acquisitions, being the boots on the ground. And then it was only after that third that I went elsewhere and got outside of the Midwest.
Was there a particular draw other than this guy that you had working with you that kind of held you in the Midwest?
No, I think when it comes to location, I having experienced what I think is a reasonable amount of experience, and the company I worked for also worked both in the Midwest and Southeast. They're different. I mean, the Midwest is typically going to be higher cash flowing, higher cap rate markets. You'll likely see less growth and have less competition, also being in the Midwest. Cincinnati, I like a lot as a market. I think it's diverse. I heard the stat. I think they have the most Fortune 500 companies per capita, actually, of any city. So there's just good diversity. Procter & Gamble, Kroger. I just, you don't have growth like you do in, Sunbelt states in the same way. So for us, I think, especially when you're longer term outlook, at least at a business level, we want to be in some of these areas that are just higher growth, even if we have to pay up relative to the Midwest. It just makes sense for us, and it's where our investors want to be.
How long were you at this investment firm? You said you did around 3 deals. What year did that take you to?
So I did it was probably just a deal a year. And I worked for that investment company for probably 5 years, close to 5 years.
And after 5 years, I mean, that's, and that's you full time, working your way up from analysts. And then you said you moved into the acquisitions side. What, what made you jump from that company? And was that when you started your current company, DXE?
Yes. Yes. At first it was just me, and then shortly after I took on a partner for DXE, but it was driven by a deal. I found a project. It was a Charleston deal, 96 units there. And it was, as part of it, we'd always be talking, my boss and I. And that was sort of the deal that was like, okay, what's the goal here, Josh? And it just led to a bigger question that allowed me to say, hey, if I'm going to take that leap, let it be now, before I'm married, before I have kids. And if I have to take 2 steps back, it'll feel better doing it now. I don't think now with the daughter I'd be able to take that leap, with real responsibilities, I would say. Especially then, I was renting. There were only so many things that could go wrong at that point in time to go for it.
Why did it feel like such a jump in risk for you? Was that not something that you could do like on the side? Like, why would you have to leave your job and feel that you'd be putting yourself in a position where it's like, man, if I screw up like this, I'm going to be having to do a few steps back?
Well, I think at some point, everyone that's sort of running the dual path is going to hit that point of just, you can't responsibly do both to the best of your ability. I think that's just the reality. I know I was sucking from both to be able to sort of juggle both my own business and then really be able to run professionally as well as I should. But in the syndication business, in a lot of cases, and again without scale, the bulk of what you're getting paid is on the buy and the sell. Sure, you're getting some sort of a fee and perhaps a share of cash flow, whatever it may be. But if you're not doing deals for a long period of time, it can get painful, especially when your goal is to do 2 deals. If you do 0 1 year, it's meaningful. So that's the thought process. I mean, I could say now I'm enough years removed where I could say without a shadow of doubt I'm not going back. But at the time, it's the unknown leap is always scary.
You said in order for you to be able to take that leap, you would have to leave that current position. Do you think that it would be possible? Like, you did some of those smaller deals, like the 60 units and the 40. Like what was so different about this deal compared to all of the other deals that you were doing before? That was just like, hey, now I've got to leave what's comfortable and move into something that is really stretching me.
I don't know, but I think it was a size thing also. Those 96 units is a $7 million deal. I did raise money and pretty broadly to be able to get it done. And it just took real time to be able to do it. And then I did have at least a portfolio of deals. And, I don't know. I think maybe it was natural to an extent, and maybe my boss at the time made it easier or almost encouraged me in some ways to take that leap, because I think he saw that it was a path eventually. But I don't know.
Did you feel ready?
I felt, I guess, as ready as you can. I think it's with any change. It's like buying, your first rental deal that you bought. There's some sort of something holding you back. But I'm a big believer, for every deal that we do, if you don't have that like gut check, pause moment, something's wrong. I think you want to be sort of always on edge as much as possible. and then mitigate risk each step of the way, also, however possible.
So, this big deal, you have to raise the money for it. Is this the first time with those other deals where you're raising money kind of through your internal network, like friends and family?
Yes, for the first two, yes. For the third, it was actually funded by just a husband and wife team, which was a little bit more of an extended relationship. But yes, the fourth was much wider. I brought on a partner that helped on the guarantee side for the loan and helped and raised some money himself and invested in the deal pretty significantly. So that helped. And I had to do that a few times really after that to just continue to build entrepreneurially, especially as I was sort of off on my own there in a lot of ways.
Was there a feeling of, okay, now the training wheels are off, right? You know, you lost somewhat of your in-house mentor and you jumped and did your own thing. Did you immediately just start soaring, or did you drop a little bit? What happened? What was that mental state that you kind of went through now that you have 96 doors to deal with?
I would say that it was not without doubts along the way. I think that jump, I don't think I could probably lie, or I could not lie and say somewhere along the way after the first few months, I was like, what am I doing here? I should be applying for jobs, or something like that. Especially, you're underwriting, offering, traveling, and nothing's hitting, but it's the reality. That's just the nature of the beast that, you're going to chase no matter what, and it's going to take time. And I think there was some gut checking going on there, but it's a hurdle that I think you have to work through. I mean, my partner, who comes from like a pretty institutional investment world, he worked for developers in the city, very professional, more traditional path like NYU real estate master's degree, and I sucked him out of a pretty high paying job. To cut his salary to nothing to work alongside me. And as many gut checks as I must have been having, for him, it must have been 10 times worse. And he was doing it with a couple kids and a family and a house and a mortgage and everything. And I think, I give a lot of credit to the people that are starting young, hustling, and just putting it together, but being responsible about it.
Yeah, it sounds really good that you guys either could see the vision of, hey, this is something that could propel me go beyond where I was before I just lost this cushy position, this 2-week paycheck. That's definitely a good feeling to have. So was this project a value add? Were you doing any type of renovation to it? What was the strategy with this deal?
So that one was actually a portfolio of two deals. It was two 48-unit deals. One of them was a pretty traditional value add deal, just a mom and pop operator. They actually, they were literally managing the property itself, a husband and wife team. So there was a lot of low hanging fruit. We needed to elevate the tenant profile. We rebranded, renovated units as they turned. We had to clean it up a bit, number of evictions right out of the gate. And then just push rents as part of that. And then the other one is a deal that I actually, it's probably one of my favorite deals. It's actually a tax credit deal where we have to maintain affordability. We have to rent to people that make less than certain adjusted median income levels. And as such, we can't increase rents. But it's built in 2004. It's in a great sub-market of Charleston that continues to grow. And over time, those restrictions are going to expire, and we'll be able to take it to market and really unlock a lot of that value. So right now, I mean, there's been a lot of demand for affordable housing. It's a great product. It's all like large 2-2s and 3-2s, so it's always full. And most of those tenants do receive some form of subsidy. So like we've held up really well throughout COVID on that or since March or so on that project, where much of that rent's backed and guaranteed.
Going back, you said you pulled your partner. He joined you. He was leaving an institution. He had a very formal background, and family. What? How did that relationship kind of come to be, and why did you see the need? Like, hey, I need this person, to be able to operate this business.
So I've known him for a long time. He actually, my cousin, right out of college, they both worked at Turner Construction. So they, and he also was always entrepreneurial on his own. He did actually a 4-unit condo development on the river in Westchester here in New York. But we used to do what was it, dinner and dreams thing, where a bunch of us that sort of were real estate centric would just meet up, talk every it might be every 4 or 5 months, and just stay connected that way. So the honest way that our business started was we were drinking one night, and he was talking about wanting to leave and being frustrated and going in different paths. And I said, hey, I can't pay you anything, just jump ship and work alongside me, and be 50-50 partners. And ultimately, that's what he ended up doing. I think that the partnership was started with the intention of growth. That there was only so much that I knew I could do on my own. My network only expanded so wide, and maybe I was frustrated with where I felt like I could take it. And I think it's nice to have a second person that you could bounce ideas off of, that you could defer to, that you could work through problems on, and it helps you keep from going crazy in like a white box, as my background's white here. But I think that I have no regrets about the partnership part of it. I think it's useful, and I think it's difficult to really do as a solo syndicator to run this business. There's just too much involved.
What were the areas that you were feeling that maybe you were lacking in, or that you were seeing in him that could really contribute to what you were trying to achieve?
So I guess it's a couple things. One, he does have a construction management background, so it's been really nice to both learn and be able to defer to him on a lot of the more extensive construction projects. So like leveling bids, approving change orders, really letting him run with that, especially when he's done it on such scale, and large projects and things like that. But equally as importantly, he just had an institutional investment background. So that same mentor always told me, like, if you're going to partner or hire professionals or whatever it may be, just partner up in a way that you're going to get pushed. And I mean, like, from a modeling perspective, knew way more than me, especially with the NYU background, underwriting side, and just reporting. So I felt like it was just in the interest of just elevating myself. And I think he saw the value that I was bringing with an established portfolio and relationships. So I think it's a complementary partnership here.
And I really like what you said about always try to be partnering up, but that also says, like, okay, well, how can I contribute to that? I'm taking a person that they're institutional, they have a good cushy job, they have a family, and now me, I'm trying to partner up to them. So how do I get them down, or how do I raise up to that level? Like, how did you do that? Is it your extreme good looks, Josh?
Yeah, that's it. No, that's a good point, and it's a subjective comment. I think you're right. For any partnership, whether it's at a deal level or a business level, or you have to bring complementary values. So in my mind, it felt like partnering up. In his mind, it probably felt like partnering up. But I think what you don't want to do is, like two people that are great at finding deals and underwriting, but they can't do anything else. Or vice versa, two people that are great project managers, asset managers. Awesome. You'll never get a deal done. So I think, you do need to find complements. And even if you're going to overlap day to day, which I think is natural, you've got to have complementary skill sets and roles, or I don't think there'll be growth really.
So, with this deal, did you find your partner at the same time, or did you start doing the deal and then you said, hey, take my partner on?
No, a little more time passed. I think I own that 96 unit deal for another I don't know, 18, 24 months before bringing Donato on. But the 96 unit deal I did bring someone on as a partner there that, like I said, co-guaranteed and got involved in the day-to-day with me just out of necessity. But that was a good example of someone that I think was a great person. Love him, love working with him, but much of what we brought to the table is identical. I don't know how many times we could have replicated that 96 unit deal.
How much money did you have to raise for this deal?
That was probably, when was that? 2017 or 16. That must have been. It's like $2.5 million, maybe a little less.
$2.5 million. So, did you have any experience, raising capital this way? Was this like, were you setting this up like as a 506B or a 506C? Like, how did you structure this deal?
Yes, and I could say that everything I learned was from the investment company that I worked for. I think we did 506. I know we did 506B at the time. So I literally borrowed everything, every relationship I could from that. Literally used the same attorneys, same title company, everything that I had a level of comfort in, and it was helpful just on the acquisition side. That would be my job. I would be getting a deal under LOI with sort of my boss's guidance and approval, and running it all the way through closing, where I'd ultimately maybe be involved in some of the early on asset management and then hand off and try to do it all over again. But yes, 506B for that one.
And what was that experience like? I mean, with the deal, what was the time period that you had to raise it in? Was it like 2 or 3 months?
Man, I don't remember. It was probably 2 months. I think it was. We got it done. We got it done.
Yeah.
I think every deal is. I'm a big believer in just trying to continue to push up, and push yourself on the money raise side. But I mean, those are going to be great deals, and we bought them with the intention of like 7 to 10 year holds. And Charleston, from when we got in there, it's done nothing but gone up. So those are going to be good ones. Still got a bunch of family and friends in there, but those same people have since been repeat investors, and they've seen the success there, and it's been a good, meaningful stepping stone, that 96 unit deal.
Part of that gut wrench, I imagine, is like, am I going to be able to raise that capital in time to be able to close this deal, to be able to put food on my plate? I just left my job. What were some of what was some of your thought process, or like how you were going to take your capital raising to that next level than what you were doing previously?
The competitiveness of multifamily has certainly changed since that deal to today. I could tell you right now, we're raising $6.5 million and have to do it basically, and we clear our diligence period and have hard money after 30 days. In the past, I think then we still had financing contingencies where we had up to like 60 days where we could walk if it wasn't going well, basically. But I think that's just a function of how desirable multifamily is. Everyone's seen, sort of, even through what's going on in the economy and in the world and the country, generally speaking, it's held up relatively well compared to other asset classes across the board. So it's competitive. Like you're seeing, even it used to be hard money you would never talk about. That was not even like on the table. Now, in a lot of cases, it's what allows you to win deals. So that's not really a desirable thing for like early on people just starting to grow their syndication business, because you're just not going to have that same comfort to be able to stretch for that. And I wouldn't encourage anyone to take that risk. You sort of have to be that much more prudent and patient, I think, to find the right one.
How soon did you, or like what was your strategy though for raising that money? Like how much of that was hard money versus money that you were taking from, let's say, friends and family versus you having to stretch outside of your network and your circle to find that additional capital?
So the partner that I took on raised probably 50% of the money on that deal from his network. So I'm the one that secured the deal and found it, and then came to him basically as I was negotiating the contract and said, "Hey, come on board. I'll give you X% of our share as the sponsor, and yet you've got to help me on the asset management side, invest personally, bring some equity, come on a loan." And then I felt much more comfortable just in being able to raise half of that, whatever it was at the time, 1, 2, I guess. I think a big part of that is just consistent communications, continuing to nurture your investor base, sending whatever it may be, a monthly, quarterly newsletter, letting people know what you're doing, announcing that Josh has split off and started his own real estate company, and just being in front of people. And ultimately, especially as you start this business, and there's a lot of if this is the path you want to take, I don't know that it's the best necessarily. I have plenty of people that are passive investors where I wished I could just be them. It is, I think there's a real responsibility in doing that. But I think that consistent communication, it's a big part of the business to be successful on that side.
Did you ever feel like maybe you didn't know enough people, or maybe you weren't going to be able to raise the capital? And how did you effectively manage that?
It still happens on every single deal I do. I get that thought. It crosses my mind, and I think there's a push that needs to happen, but in the same breath, you can't go into any deal looking at it and saying, I have no idea where this money's coming from. So I know that's me talking out of both sides of my mouth, but it especially in this environment, short time frames, real deposits that are at risk, and a lot of young people that want to get into real estate and are, I think, fascinated by the get rich sort of quick path. But it's not. It's the exact opposite. This is like meant as a get rich slow game. I think that's really what it is. So I think it's just wise to take on what you can handle ultimately, and try to take steps and not expose yourself and your investors too much.
Not only are you raising capital, you're having to do the deal, but you're also you're setting up this new business. What were some of the struggles with the business side? I saw one of the things that you put that you said that you have kind of some expertise in is Airtable. So if you wouldn't mind talking about maybe some of the business systems that you started implementing that allowed you to be able to keep a lean team and still be able to operate full time.
Mm-hmm. Yeah, it's been just the assorted tools like Airtable. I love Airtable. I think it's just easy. I guess it's almost like Google Sheets, but maybe a little more user-friendly in my mind. Airtable is one of them. We use a investment management tool. We use Appfolio, which is just helpful, especially when you're syndicating deals. Maybe you have 40 investors on that deal. To be able to just easily communicate, easily have just an organized track record of people opting in and signing paperwork through there, and communicating back to them after closing just through quarterly updates or monthly emails, whatever it may be. So I think those are probably the tools outside of like the usual Microsoft Office suite of tools that we're really in day to day.
In which way are you utilizing Airtable?
We host our pipeline in there. We'll use it for contact management purposes, and also rent comps. All of our rent comp tables will just segment different tabs to different cities that way, especially over time, it's great to be able to come back. We're doing a deal in Atlanta now. Maybe, 6 months ago, I may have underwritten a deal in the same submarket of Atlanta. Now I could look back, see where those comps were, where they are today. And I think it's powerful now. And I think with time, it'll only get more powerful to build up on that data.
So after that first deal, that 90 so units to where you are today, what was it like scaling your syndication business?
It's good. I think that we are continuing to scale. I think we're not where we want to be yet. We've probably, myself and Donato at DXE, maybe we've done $50 or $60 million worth of acquisitions. We really want to be in a place where we're consistently doing, I don't know, call it $30 to $40 million of acquisitions a year. So it's going to take time, and we're happy to allow that to happen. But I think that, we're gradually taking that path. What I think we're mindful of now more than ever is, especially as we wanted to build some just momentum. We did some small deals, smaller than what we should have been doing, and what we were able to be doing. Like we did a small, like $1.5 million retail deal that has like a redevelopment aspect to it. That is just it's not. It's going to be a good deal, and it's actually in contract to sell now, so it'll be off the plate. But the time versus reward on that is just not worth it. So it's apparent, and we knew it when we did that deal even, but we needed to get the wheels sort of moving and doing good deals, most importantly.
Speaking of scaling and growing and your projections for your company's growth, how has your team grown around you?
That's a good question. I think earlier when I said we're in the Carolinas and Georgia, part of that's been with the intention of just scale and working with teams that we really, really believe in. It's not fun to change property managers sort of midway through a project. You're only doing that if something's going wrong. We have now a team of it's a couple property managers across those states that we really like. They have meaningful scale. They've been able to just work our way through significant projects and repositioning efforts, and I think there's nothing more important than the people that are really doing the work day to day at the end of the day.
So that means you're doing some of your property management in-house or all?
No. Third-party property management across all but that one retail deal, which we're actually in the process of selling, and then the third deal I ever did, I ended up taking property management in-house. We actually found out our property manager was stealing from us, caught him, fired him, and just hired the staff directly. And it was really successful, and it's probably part of why we were able to get such a great return on that deal. But it is difficult, and it's a people business. To be able to take property management in-house without meaningful scale in any given city is really, really tough. It's just tough to find good people, and that's, I think, what allows anything to be successful or not successful.
What has been your biggest real estate failure, the biggest thing that you feel that you failed on that you have now learned from?
Yeah, I think it goes back to those very early deals. Both the 20 unit and the 44 unit deals were just pretty rough located deals. You could probably tell by the price points that I stepped into them at. And they were bought, and originally day one, I bought them with the intention of holding them for a long, long time and just being able to do great with them. But I realized very quickly that there's a certain, at least, and there's people that do it efficiently, but I have not found the formula to manage like some of those C- deals that I've never found any consistency there. Never really had a meaningfully consistent cash flow. So my takeaway there was just, you have to be willing to pay up for location, and people are always going to be willing to pay up for location, but you're definitely not going to see me sort of stepping into a 9 cap deal today with the expectation that I'll somehow, some way be able to operate that. I just don't think it exists.
And how have you been working around with all the changes? I mean, with things like COVID going on, with a lot more people, probably in the multifamily space, maybe driving cap rates down. How have you been handling maybe just like a shortage of really good deals, as well as some of the uncertainty in the market?
Yeah, no, I think that's a great question. On the underwriting side, we're trying to take a few preventative measures. So one, we're flatlining all market rent growth in the first year. Two, we're ticking up bad debt and vacancy in that first year, at least 1%, if not 2, for both versus just historicals, or at least sub-market historicals. And then 3, any capital plan, we're extending the amount of time that we expect to complete it over. So if we're going to upgrade every single unit across 100 units, and we typically do that in 2 to 3 years, we might assume that we're going to do it in 4 years, just to give us some wiggle room to press stop for a few months if we need to, press start, and be able to catch up and not really impact the overall returns. It's still, I could definitely tell you, it's still competitive. I do think pricing has adjusted a little bit from pre-COVID, earlier this year to now, but much of that's driven just by the debt environment. I don't think it's necessarily demand driven, but you're seeing like less leverage and reserve requirements. So that's just forcing you to bring more equity and force prices down a little bit. But we really try to minimize our competitive set whenever possible. Most of our deals that we've done, especially only doing a couple a year, have been like off-market deals that have a little bit of hair, a little bit of a story to them, where we feel like we're just buying into some value. We're always chasing a story, I guess. That I think is what tends to excite us, something a little outside of the norm there.
And what do you see the biggest mistake that maybe new real estate investors are making, or other people that are jumping into the space? You've definitely got some salts underneath your skin, and definitely seasoned. So where do you see maybe some new people, if you could impart that wisdom on them?
Sure. I one thing that irks me, and I'm a great example of someone that did what I do not suggest, but I do get irked when there's a lot of just capital raising going on with like really no experience, and people are shooting from the hip and going wide, and I think it's just completely irresponsible on that side. I'd say, get involved on your own, maybe try to partner and take some steps. I think that would be pause number one. I think, number two, it's probably size driven. That sometimes when you're buying deals that are, in my mind, like the 20-unit deal, it's a small deal, it's far away. The property manager has to do scattered site management, pairing it with other deals. It's just so much less efficient than something larger. So I think, especially when you're talking about those smaller deals, they've got to be better located. Like, you guys in most of your deals are going to be well located just inherently because they're short-term rentals. They have to be desirable. So it's a little less of a issue there. But I think ways that things could really go sideways is buying like some of those smaller deals that can't be fully staffed because it's not operational and they're in a mediocre location. I think that's sort of a risky formula to step into.
And why do you see so many people maybe being attracted to those deals? Is it because there's not enough, profitable deals out there, and people are just trying to stretch themselves too thin? Or why do you see that as being a lesson for people that are just jumping into the space?
It's just it's an unknown. So you don't know how it's going to run necessarily. You might throw a 10% property management fee and assume you'll run it $500 a unit in repair and maintenance. But I think everyone knows that if you're evicting 10% of your units every year, you're going to never operate at those numbers. So I think that's the why. It's just people, you're seeing that it pencils out great. Even underwriting conservatively, it's an 8 cap. You're borrowing at whatever, sub 4%. What could go wrong? And I think that's where I just express some caution.
If you could start from scratch, what would you do differently?
I probably would have gone to college with a real estate focus. Maybe taken the path that my partner did and get a master's degree or something real estate centric. I just think my foundation after that would have been much stronger. Who knows, if I took that path, maybe I wouldn't be here today. Maybe I needed to get some grit and to be able to keep pushing myself. But I think like that's, to me, the easy answer if I went back in time.
Okay. And where can our listeners go if they have any more questions, Josh? If they want to find out more about you, your company, and what you're doing, how can they best contact you?
Yes, DXEproperties.com. You can sign up for our newsletter there. We always try to get out just a monthly something, whether it's about us or about state of the market, something we're seeing with rates. But we really try to keep it pretty multifamily centric. And then along the same lines, I'm always happy to have an intro call or just connect.
Awesome. Of course, and we'll include all the links in the show notes down below. But thank you so much, Josh, for taking the time to be able to share your story. I think, you're just, sometimes you talk to people and it seems like they have everything figured out. It's just like, oh my gosh, like they make it sound so easy. Like, why isn't it this easy for me? But I think, you're very relatable. It's like, I can understand. It's like, just a guy that's going out there and doing some really amazing things. But I think, like what you said, that gut wrenching feeling that you have, if you're not feeling a little bit uncomfortable, which is probably where a lot of people maybe feel, it's a normal thing. And you still feel that way?
Yeah, no, totally. I think if it's too easy and you're making it seem too easy, something's wrong. I'd say run. I think my old boss, I think he's probably bought 10,000 units, them directly, not through weird partnerships or whatever. And he has that same sentiment. And I fully do believe that.
Awesome. Well, thank you so much, Josh, for taking the time. And until next time, deal makers, talk to you later. Hope you all enjoyed this episode. If you did, please go on over to iTunes and leave us a review, as that greatly supports the show. And if you'd like to be able to connect with John, the community, and I, then come and join us on our Facebook group, the Multifamily Success Network, where you can connect and make deals with other multifamily investors. Go to multifsuccess.com/community.